I'm joined today by Aziz Hamzaogullari, Chief Investment Officer at Loomis Sayles Company. Aziz is among the incredible investors sharing insights at the Equities Investment Forum today. Welcome, Aziz. It's great to have you with us.
Thank you so much for having me.
Aziz, how does volatility and dispersion in equity markets create opportunities for active managers?
It's so interesting when you look at empirically over the last 150 years, we had 23 drawdowns that are 15% or more, which tells us volatility is inherently structurally in place in equity investing. And actually, if you look at the last 2 decades, when we managed money, you find that actually that frequency increased. So at any point in time, we can go back in 150 years and find that these events were happening and everyone thought this was a new thing that was happening, but in reality, it was a pattern that was consistent. Opportunity for truly active managers to outperform going forward is no different than we believe than in the past, but most managers are becoming less and less active and also becoming more trader oriented. What I mean by that is if you look at the active management over the last several decades, you're going to find that the high active share managers declined as percent of total significantly. Actually, if you go back and look at I think it was 4 or 5 decades ago, 6 out of 10 managers were what we call high active share managers. That declined to in 2009 to 2 out of 10 managers being active. And then with that, also we had significant increase in trading. So if you go back and look at the average portfolio turnover in 1955, it was 15%. In 2009, that number was 105%. So when you take managers that are already very similar to the benchmark and they trade a lot, we believe that's not a good combination. And the basic math tells us that if you have a certain information ratio, your ability to add value, and you have low active share, that will work against you with a lot of trading.
And how do you approach risk in uncertain and volatile equity markets?
So we believe that volatility is structural and permanent. So when we look at the past, and we already established in the last 150 years, we had so many different drawdowns. We believe it is so much better to understand that these drawdowns are unpredictable and therefore require a permanent approach to risk. So we don't believe that you have to have a risk-on, risk-off approach, but rather a risk-on approach all the time, because it's the risk that's around the corner, that's not measured, that no one talks about or quantifies that matters, not the one that we already identified and discussing in the daily press every day and fretting about it and reacting to it. So we believe that you have to take an active approach to risk, and we define risk as permanent loss of capital, not tracking error or short-term relative underperformance versus the benchmark. And we believe the best way to manage risk is through business driver diversification. And what we mean by that is looking at your portfolio and understanding for each holding that you have, what is the primary driver for cash flows, and then asking the question how that business is correlated to all other businesses in terms of cash flow growth fundamentally in the long term and structurally, and diversifying those business drivers to overcome these periods of major drawdowns and manage risk.
And why do high-profile stocks like the Magnificent Seven dominate investment discussions?
I think one reason that we talk about Mag 7 is the performance that these companies had in 2023. They were the best performing companies that year, which highlights the perennial recency bias that infects a 24/7 news cycle and dominates the prevailing investment narrative. And before Mag 7, we had other variants like FANG, the Four Horsemen, Microsoft, Intel, Cisco, and Dell, and in 90s. And then, of course, we had the Nifty 50. And one has to realize that Mag 7 is composed of companies with very different business drivers. And the reality is their returns in the last 10 years have been significantly different. So meaning the divergence between the best performing company and the worst performing company in the last 10 years was about 100% in any given year. We believe that rather than going the nicknames and the tendencies of the media and investors focus on that, we believe the best way to approach Mag 7 or any other business is to discern what the key drivers are fundamentally going forward and understanding the quality, growth, and valuation aspect of each business and making allocation decisions accordingly.
So many active managers pursue differentiated returns by taking underweight positions in stocks like the Magnificent Seven. How would you suggest investors think about balancing concentration risk with the opportunity cost of being underweight these mega caps?
I think that any concentration or any capital allocation decision needs to be intentional based on the investment approach that a manager has. In our case, we are focusing on three key drivers: quality, growth, and valuation. And we believe that high quality simply means a business that would be very difficult to be replicated by someone else if they had time and capital. And history shows that less than 1% of the businesses out there can maintain their above average returns over the long term because in most cases, actually 99% of the time, those returns are competed away when competition and capital comes in and competes with this business. Similarly, in terms of growth, that's also very rare. Less than 1% of the businesses have above average growth beyond a 5-year time frame. So also we believe that having quality growth and on top of that valuation is a very, very rare occurrence. We believe that the key is not just what you own, but how you own it over time. And when we look at history for Mag 7 companies, what you find is less than 1% of the managers own these names continuously, and 99% chose to really trade these names. And there's a major difference if you owned a name like Amazon for 2 decades continuously versus you traded it. And the reason that people may have traded these Mag 7 names is all of them had major drawdowns consistently over those last 2 decades. And most managers maybe choose to trade based on those events rather than understanding these are really rare companies and own them for the right reasons. So it really comes down to not just for Mag 7, but for any business out there to understand why you own it. And if it is really rare and has these, in our case, quality, growth, and valuation characteristics, to own them for the long term rather than try to trade around them.
And so what about opportunities beyond the Magnificent Seven? Hundreds of companies have outperformed both the S&P 500 and the Magnificent Seven. What common characteristics do those companies share?
In our case, we believe that beyond Magnificent Seven, there are many, many opportunities out there. And the way we approach that is we look at quality, growth, and valuation. We always start with the quality of the business. For us, high quality simply means a business that would be very difficult to be replicated by someone else if they had time and capital. And that's, we believe, happens only less than 1% of the time. Meaning 99% of the businesses don't have the quality characteristics that we are looking for. Then if you are convinced that a business is sustainable in terms of competitive advantages, then we focus on the growth. That's also very rare because we are focusing on long-term cash flow growth. And we also want the growth to be profitable. That's why we focus on cash flows. And lastly, we want to buy these businesses at a significant discount to our estimate of intrinsic value. So those three things coming together doesn't happen every day, and we usually make like 1 or 2 decisions in a given year. Beyond Magnificent Seven, we see many different opportunities, like in the case of a company like Monster Beverage, which is driven by increased consumption for energy drinks, or a company like Vertex, which is benefiting from providing solutions for cystic fibrosis population. So there are many companies with different goods and services that are needed by enterprises and consumers, and we are trying to find these exceptional business models with quality growth and valuation and invest in them accordingly based on risk reward.
Aziz, thank you so much. We're going to need to leave it there and get back to the forum, but I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Equities Investment Forum.
Thank you.